Hi, everyone, and welcome to my top 2 safe dividend paying Canadian stocks for your TFSA for 2022. I'm guessing because everyone's getting another $6,000 in their TFSA, let me make a video about it. But you can purchase these in your RSP, RESP, or your margin account, not necessarily your TFSA. I chose these stocks mainly because they recently announced growth of their dividend and more than 5% as well, one as much as 18%. I would never recommend a stock I didn't currently own or didn't own in the past, but right now I don't own any stocks because of my options trading. So I have 0 stocks, but I had both of these stocks I'm recommending for over 5 years up until January 2021, where I sold everything. Getting right into it, my first choice is Manulife. The ticker symbol is MFC.TO. It is currently $24 per share, and their dividend yield is 4.69%. So they pay $1.12 per share that you own. If we look at why I'm recommending this, mainly because I feel like they're undervalued. If we look at the last 5 years, there hasn't been much growth. It's been pretty stagnant. So that is kind of a downside, but I do think it's poised for growth. Maybe not, maybe 10% in the future, maybe even more. If we look at the PE ratio, the average PE ratio for the TSX 60 index is 18, and the PE ratio of this is 7. So it does mean it's undervalued. It does mean it has room for growth. I don't think this will get to 18, but if it gets to 10, if it gets to 11, I think that would be decent. If you want to know what this means, price to earnings ratio. The earnings is here. How much is the price worth in comparison to the earnings? So just like an easy way, if you multiply the PE ratio by the earnings per share, you should get the share price. So if we go 7.06 times 3.4, enter, why isn't it working? Equals 24. So that is the share price. How to judge this is comparing it to its peers and to other companies. Like another good dividend stock on the TSX would be TD. If we go TD.TO, let's see what this is. So this has a 12 PE ratio. So it does mean Manulife does have room to grow. It might be a little undervalued. If you want to know in comparison to something that I think is high, Tesla, 332 PE ratio. So this might seem overvalued, and then this might seem undervalued. They recently announced a share increase of 18%, which is pretty impressive. They had like an increase freeze by the OSFI, the Ontario Superintendent of Financial Institutions, I guess. They had to maintain a 28, I think it was like 28 cents per share per quarter. And the ban was lifted, and they recently were allowed to increase to 33 cents. If we take a look at their history, this just ruined their 10 or 11 year streak. So if we go back to, they haven't missed a dividend payment since they first started paying. I think this all goes back to 1999. But if we go to like 2008, 2009, if you look at the recession, the financial crisis of 2008, they were paying 26 cents per share, and they had to cut 50%. It's taken them, I think, 12 years. So they were at 26 cents. It's taken them 12 years to get back to, okay, I'll say 10 years to get back to that 28 cents. They didn't, thankfully they weren't doing too bad. This wasn't a financial recession like it was in 2008. So they didn't have to cut any dividend, but they did have a freeze, and they were recently able to increase it. They do have a really good, this is like a financial institution type payout ratio. They're trying to maintain, let me try to find it. They're trying to maintain a payout ratio between 30 and 40%. If I could find their payout ratio here, 32%. This is super low. I believe TD had something like 40%. If you want to compare this to REITs have 80 to 90%. So this, definitely has room to grow. If you want to invest in their dividend reinvestment plan, I would go to their investor section of their website, click on Investor Contacts, Canada, AST Trust Company. So you click on this website, it'll take you to this TSX Trust, and you want to go to Forms. And then you go to Enrollment Form, Dividend Reinvestment and Share Purchase Plan for Canadian shareholders. Click here. You will fill this out, submit it. This is for Manulife, and you should be able to enroll in their dividend reinvestment plan. If we look at their quarterly results for Q3, does look pretty poor, but this is just upon first glance. And when you get into the details, you realize that this is pretty okay. This is just like a one-off. They went down from 2 billion net income to 1.5, mainly because they had, it was the Hurricane Ida they had to pay out. And there was also the floods in Europe. So they had a very bad quarter, but they seem to be trending well overall. So quarter over quarter, it looks bad. But then you look at the year to date 2020, year to date 2021, it's almost a billion increase. And then there's other few items you have to look at when it comes to financial institutions and insurance, the LICAT ratio. So this is the life insurance, I wrote it down, life insurance capital adequacy test. They must maintain, I think, 90 to 100%. So if all of their life insurance policies, how I understand it, came to call right now, if everyone died, this is pretty dark, and they had to pay it out, do they have enough cash? Do they have the funds? And they have 138%, so more than enough coverage. I am leaving this pretty basic. There's nothing else to go over. I'm trying to keep this video short. I do believe this is a good stock to hold, mainly for the safe dividend. You won't get much capital appreciation, but if we look at the PE ratio in comparison to the peers, I do think it has room to grow. That is my first pick, Manulife Financial Corporation. Moving on to my second pick, Telus. The ticker symbol is T.TO. Make sure it has a .TO because I think AT&T is the one in the US, so you don't want to be buying the wrong one. If we look at the share price over the last 5 years, right now it's 29.4 per share. It was 21.72. It's had over a 40% increase in the last 5 years. It's paying a dividend of 1.31 per share, which is 4.45% yield. They recently increased their dividend by 5.2%, which is fantastic. And they've also been doing, I think they're doing semi-annual dividend increases, and they increase 5% in the summer and 5% again in the winter, which is awesome. The analysts are currently targeting this within 1 year to have a $31 share price. These are always hit or miss. I wouldn't take too much stock into this. If we look at their dividend information, you can see they've been paying out. They recently increased Q1, they had 31, and then in the summer they increased to 31.6, now 32. They've been increasing steadily since since 1999. But they did freeze, so their dividend increase streak also froze in the financial crisis. Let me try to find it. Okay, here. So in 2009, they didn't have any increase, but then they slowly resumed once the market picked back up. If we take a look at their financials, again, my favorite thing is looking at trends. You see the trend, you can't be too mad in 2020 if they did lose income, but it looks like Q3 2021, they're back to their, they're able to beat their Q1. This should be the most relevant one. This should be their highest, I believe. So they are slowly coming back to their net income numbers. Let's take a look at, I want to see, they do have a chart somewhere. So this is just a graphic breakdown of the customer connections. Basically, there's cell phone plans and they have fixed and mobile. That's fine. Mobile is obviously their biggest, but it's been increasing since 2019 every quarter, which is interesting considering they had lower net income every quarter. So higher connections, which you'd think would mean more money, but then lower net income. When I dig into this 2020 number, you notice that they're mainly taking provisions for losses. So a company every quarter has to estimate, is there part of our accounts receivable that we can't return? Do we think all our accounts are going to be paid off? They have to take a reasonable estimate. During the pandemic, they probably took an estimate pretty high, which is good considering the economic situation. So I do think this was artificially decreasing their 2020 numbers, and it's slowly been creeping back up as the economy recovers. Is there anything else I want to say? Nothing really. I'm trying to keep this short. This has a PE ratio of 30, so it might appear overvalued, but people might be buying in due to their semi-annual dividend payments, dividend increases, and their positive Q3 results. So I wouldn't read too much into this. Earnings per share 0.95, so they are trading at a higher than the TSX 60. I do think this is a buy and hold, mainly for the consistent, stable dividend, also the semi-annual dividend growth. I'm going to leave it here. Thanks for watching. Let me know if you want more in-depth analysis. Right now, I'm just giving my quick opinion based on what we can see on the press release and Yahoo Finance. I used to make longer 15, 20-minute videos. People used to cut off at the 10-minute mark. Hopefully this is shorter. Thanks for watching and tune into the next one.